Managing Partner of GFM Wealth Advisory. Welcome to our webinar this morning with Magellan to find out more about what's happening in global share markets and global listed infrastructure. We're absolutely thrilled to have Magellan assisting us with today's webinar, and it's so pleasing to see we've got a significant level of registration for what is our first ever webinar. A big welcome to our GFM clients that are dialed in this morning, and we're also in the position where we have many guests joining us, so welcome. As long-term clients of GFM would know, we're a very social business. We love running client events. Needless to say, these are different times and client face-to-face events are not possible. So keeping with the theme of having to adapt, we're holding today's webinar. We sincerely hope you enjoy the session. As I alluded, these are interesting times. COVID-19 has not only had a significant impact on the way we lead our lives day to day, but it's also had a very significant impact on investment markets. We've seen an extreme level of volatility since the onset of COVID. Fortunately today, we have Gerald Stack, Head of Investments, leading the team responsible for Magellan's infrastructure portfolios, and Stefan Marcinetti, who is a portfolio manager of the Magellan Global Trust. Now, I'll introduce both Gerald and Stefan in a moment. They're here today to help us make sense of what's going on in global markets and to give us an update on the Magellan Global Trust and the Magellan Infrastructure Fund. Now, before we get underway with Gerald and Stefan, I have an important disclaimer to make, and that's that this morning's webinar is general in nature. It's not personal advice. Should you be seeking more detailed information in relation to your personal circumstances, please make contact with our office and one of our advisors would be more than happy to assist. Also, during the registration process, we asked those who are attending today's webinar if they had any questions. We were quite overwhelmed by the number of questions that were asked. We can understand that this is an environment where there are lots of questions. So we're going to do our best to answer all of those questions over the next 45 minutes. But by sheer volume of the number of questions that we've got, it's going to be very difficult for us in the time frame of this morning to get through all of it. So if you feel like the question that you asked doesn't get answered today, please, again, make contact with our office and we're more than willing to help. So Stefan, I'll get underway with you first. I guess, would you mind just providing a short background on yourself and on the Magellan Global Trust?
Sure, and thanks very much, Paul, and good morning to everyone. Look, myself, very quickly, it's not that exciting. I've worked in Magellan now for about 7 years. And prior to that, I started my career in investment bank at Deutsche Bank, and then I worked at a equity long-short hedge fund in London before I joined Magellan. And when I started Magellan, I was originally covering media, actually, in our tech team. And then about 5 years ago, I started working quite closely with Hamish Douglas, who's our CIO, co-founder, on the main global equity strategy. And about 3 years ago, I'm a portfolio manager, a co-portfolio manager with Hamish on MGG, Magellan Global Trust, when we launched that. So that's me. And then look, Magellan Global Trust, MGG, it's as you're aware, it's a listed closed-end vehicle on the ASX, but that's kind of the structure of it. And we do, in the MGG vehicle itself, so to speak, what we do is we give a consistent 4% cash distribution. You know that in a trust investment structure, the returns are kind of lumpy because they're based on realized capital gains. Particularly people like us who are infrequent traders, it ends up being quite lumpy. But we smooth the cash flow to investors, so it's actually 2% every 6 months. We think that's a helpful thing, hopefully. But in the portfolio for MGG, what it is, it's a portfolio of the world's best businesses. We're around it. Think of it as a 20-stock portfolio of the best businesses in the world, constructed in a way that really we're very focused on risk and focused on downside protection. That's really what MGG is as an investment portfolio.
Thanks, Stefan. And Gerald, likewise, a quick background on yourself and on the strategy you head up, the Magellan Global Infrastructure Fund.
Sure, Paul. And welcome to everyone this morning. So my background, I started out a long time ago as a chartered accountant. Too long ago to want to reminisce too much about that. In 1993, I joined AIDC, Australian Industry Development Corporation, where I was part of a team investing in unlisted infrastructure projects. I was there for a period, and then I went to a firm called Capital Partners, now known as CP2, where we provided advice and invested in both listed and unlisted infrastructure, both debt and equity. And then I joined Magellan around about 13 and a half years ago, January 2007, to head up the infrastructure team at Magellan. Today we manage about $16 billion. We've got a team of about 7 guys in our infrastructure investment team. And we're very much focused on what infrastructure is and is not. Infrastructure investors have typically defined infrastructure by virtue of the term essential assets, that is, assets that provide services that are essential for the efficient functioning of communities. So if you like, the provision of energy, the provision of water, the provision of transport, these are the key essential services. What we do is to say, okay, that's a nice starting point, but really what we think investors are after when they come to infrastructure is not so much the physical form as they are a certain risk return characteristics. That is, with infrastructure, they expect highly reliable investment returns. So infrastructure, as we structure it, as we define it, is not a get-rich-quick scheme, but what it should do is give investors a high degree of confidence that they'll build their wealth progressively over time. So it's about the confidence in growing wealth over an extended period. And that universe is around about the size of the Australian Stock Exchange, about $1.5 to $2 trillion US dollars. It's only about 130 companies, so they're generally pretty large companies. And that's the universe that we play in.
Fantastic. Stefan, now I'm very keen to talk within the Magellan Global Trust about the investment selection process and what you would tend to think are the hallmarks of the investments that you put into the portfolio.
Sure. So I'd say, just to frame it, we have 2 simple investment objectives. And the first is to make a decent return over the longer term. And the second is to preserve capital. And when I say preserve capital, what we really mean is we want to avoid major drawdowns, major investment mistakes. We want to have a portfolio with much lower volatility. And so when we think about constructing our portfolio, our selection process, it's really about thinking about how we can maximize the chance of achieving those objectives. That's what we're really all about. And there are some key things that we're doing to achieve that, which I sort of touched on. I think the first of those is probably the most important. It's kind of a core to Magellan's DNA, is that we restrict ourselves to very high quality businesses. There are thousands of stocks in the world that we could invest in. And we actually narrowed that down to just a very small universe of really what we think are the best. And when you think about, it's pretty easy. If you say, what's a high quality company? Actually, having your chat in the pub, so to speak, it's pretty easy to identify what's a business that's doing well today. And that's all good and well, but that's not the important thing. The judgment we're making, when we say high quality, we're looking for a business that has a competitive advantage that's going to be sustainable for 20, 30 years into the future. And actually the key thing here, the key word here is sustainability. Because typically when you have a business that's doing very well, making great returns, great margins, capitalism tends to be quite brutal and competition sets in and that advantage gets eroded. And often that happens very quickly. So you get a brief moment in the sun, and often people buy them when the sun's shining brightest, and it ends up being a terrible investment. And so what we're really looking for is if we can identify businesses that have something that protects them, that makes that advantage sustainable. You think about some of the businesses in the world. You think about Alphabet, the owner of Google Search. Google Search, outside of China, it has 90% of the global search market. They probably spent tens of billions of dollars over the years developing that business. It's incredible business. And what that means is someone trying to compete with that is kind of kidding themselves. You look at Louis Vuitton, another one, the world's leading luxury goods company. The Louis Vuitton brand, which is more than half the company's earnings, it's 166 years old. So, you can't invent a luxury brand that has that heritage and that authenticity. You can't compete with these types of businesses. That's what we mean. That's what makes them sustainable. And that's really what we're looking for. And when you think about our investment objectives, businesses with these advantages, they tend to grow faster. So they're going to get you a better return. And when things go wrong, and things go wrong for every business in the world, no matter how strong it is, but a strong business has got so much to fall back on. When something goes wrong, they tend to recover and get back on their feet pretty quickly. It was a weak business. When something goes wrong, it often ends up being a permanent loss. They never can recover from it. So when you think about capital preservation, business strength is a really important part of that. And I'd say, frankly, my personal opinion, look at, our main global equity strategy has had a great return performance over the 13 years. And I think probably the single most important driver of that over the longer term has been our really strict focus on quality. Look, I'd say a second thing I'd point to, I think, we're quite disciplined on valuation. We do all our own work. We're not relying on consensus or anything like that to value a business. And we just stay disciplined. We look over the longer term. And I think often when you're looking over the longer term, it's a bit of a wood for the trees type argument. Now, the market can get very caught up in momentum and short-term issues and really missing the big picture. And the big picture is what's going to drive your longer-term outcome. It's not the short term. So that's important to be disciplined. And I'd say the final thing we're doing that's important, particularly around achieving a capital preservation and lower volatility outcome in our returns, is really our approach to risk management. Now, we take I would say, a very broad approach to risk management. We're looking at risk from many different angles, because risks can come at you from many different places. At the very bottom stock specific level, if something's happening with a big product in an individual company, that's a really a micro type issue, right up to the very top level of, what's the Federal Reserve doing with interest rates? Where's monetary policy heading over the next 5 years? Those macro risks. And in between, there are many different things. So we're really looking out into the world to see where all the potential headwinds to our portfolio can be. And then we want to position to minimize exposure to some of those negative risks. And we also want to focus on our overall risk appetite, our overall market exposure. I'm sure we'll come to it a bit later, but our market appetite right now is actually quite low. We're really quite risk averse as we are now. So it's making those judgments that is really important to delivering a capital preservation and lower volatility outcome over the longer term. So I'd say that's the main way I describe our investment process.
Great. Gerald, likewise, I'm very keen to understand the investment selection process within the Magellan Infrastructure Fund. But before you do so, you touched on this already a little bit, but I'm very keen to understand your definition of infrastructure and the type of infrastructure that you will and you won't invest in.
Yeah, look, Paul, it's really the key thing that we do when it comes to investment selection is getting definition right. As I mentioned already, when investors come to define infrastructure, typically they've done so by virtue of its physical characteristics. That is a big, ugly piece of capital equipment, a road, an airport, a power station or the like, that's providing an essential service. And because it provides an essential service, the thinking goes that demand is reliable over time. And quite often demand is reliable, and that's a good starting point. But what we're really after is reliable earnings and cash flows. And so what we want to make sure is, okay, we've got an asset that's providing essential service, but there's not some external variable that comes in and upsets the apple cart that means that ultimately cash flows and earnings are not reliable. So what we're focused on is avoiding those external variables. And the key three variables that we want to avoid are commodity prices, competition, and sovereign risk. So let's deal with competition first. If you think about electricity, clearly an essential service. Well, electricity comes to you through a 4-part industry chain. Someone generates the electricity, you send it down high voltage transmission lines, you step that voltage down into distribution lines, which come into your home or place or business, and then someone sells you the power. So 4 very distinct parts of the industry. Now that first bit, power generation, in calendar 2019, the average wholesale price of electricity in Australia was about $90 a megawatt hour. Differs from state to state, but about $90. Now, compared to that average price of $90, the maximum price was about $14,000 a megawatt hour, so 90 to 14,000, and the minimum price was negative $500 a megawatt hour when they're paying you to run your air conditioner. So you've got a highly variable price. So as much as I think we can all agree that electricity is an essential service, for power generation companies, they face a very volatile price curve and therefore volatile revenues and earnings. So we want to exclude exposure to that. And many of the utilities we face around the world, utilities represent 60% of our universe. Many of the utilities have more than, say, 25% of their earnings coming out of that space. And that's essentially our test. 75% of your earnings have got to come from the regulated core components, transmission and distribution, and no more than 25% out of generation. So we throw away a lot of companies in that step. So that's the first thing. That's sort of the impact of competition. Competition is a wonderful thing for economies, terrible thing for infrastructure investors. The second thing that we're after is avoiding commodity prices. So many of your clients will have heard of the fracking revolution or the shale revolution in the US, where through the improvement in production techniques, a number of oil and gas production companies have been able to access oil and gas basins and deposits that were previously thought to be uneconomic. And what that's meant for pipeline companies is that there's needed to be a raft of new pipelines built around the US to transport that oil and gas to the community so they can use it. Now, these oil and gas pipelines look and feel and smell a lot like infrastructure, big ugly piece of capital equipment, a lot of capital expenditure day one, relying upon a long series of cash flows into the future. The problem we have with these companies is that typically they toll the value of the product that goes through the pipeline. So as the oil price rises and falls, so does their revenues and so does their earnings. So what the problem we have with that is one of the things we're not good at is forecasting oil prices. Or indeed any commodity price. And I might add, it's not apparent to me that anyone's good at forecasting oil prices. So we want to avoid those assets. So we want to avoid power generation. We want to avoid oil and gas pipelines if they're tolling the value of the oil and gas rather than the volume. Volume we're fine with. Volume we can predict. And then the final thing we want to avoid is sovereign risk. And really the place where this has the most impact is China. China has incredibly attractive themes as it pertains to infrastructure. Car ownership has grown at something like 10% per annum for about the last 20 years. Essentially in China, if you build a toll road, they will come. You will get traffic. But the Chinese government has a somewhat unfortunate habit of interfering with the rights of not just private individuals, but private companies. And so we've seen, for example, that on the 8 national public holidays, they've mandated that toll roads are free on those days. And that was back in 2011. That worked so well for them. The following year, they went, okay, well, that's because people are going back to their villages. You probably want to go a day before and leave a day after. So we're actually going to give you 20 days of toll-free travel. Now, that's fantastic for the population, but a pretty terrible thing if you own the road. And those road companies have been unable to get any compensation for that. That's not to say that these things don't happen to you in Australia or the UK or the US or Canada, but here in those jurisdictions, you have an ability at law to go and protect your rights, whereas you don't in China, you don't in Russia. So we want to avoid those countries. We're avoiding competition and power generation. We're avoiding commodity price. We're avoiding sovereign risk. And that means our potential universe reduces from potentially around about 350 companies that exist in most of the major infrastructure indices, the benchmarks that are out there. We reduce our universe down to about 130 companies, as I said before, market cap of about $1.5 to $2 trillion US dollars. So what we're doing here is just reducing our potential investable universe to those things with highly resilient, reliable income streams over the longer term. As Stefan rightly says, things go wrong in the short term, but we can be very confident that people are going to want electricity in 5 years' time, that people will use toll roads in 5 years' time, and even at the moment, that people will come back and use airports in 5 years' time. We can't necessarily be confident about what happens next year, but we can be confident about the future, and that gives us some confidence and to make sure that we can grow wealth for clients over the longer term at a very sustainable rate. So that's the essence, that's the key part of what we're doing. Once we've defined the universe in that manner, then we're following a very similar path to what Stefan's talked about for the global equity strategies. That is, we're looking for quality and value. We're looking for those things that we have a particularly high quality, which within what we would regard is already a very high quality company universe. And we're looking for the best places to play with value.
Thanks, Gerald. Stefan, an excellent question from our client. One of our clients was around COVID, and obviously COVID has had a significant impact on global markets and the way we function day to day. Are you prepared to spend a little bit of time talking about what you perceive to be some of the winners and losers as due to COVID-19?
No, look, absolutely, Paul. And maybe I'll broaden it out and talk to you a bit more beyond just beyond just the COVID situation considerations as well. And look, I think when we think about COVID, let's think about this in two distinct periods here. You've got the pandemic period, and then you've got the post-pandemic period. And we've got a big question: what does the economy look like once we're out of this pandemic? I think that's a very important investment question. And look, the pandemic period, as we know, we have lockdowns, we have social distancing. So what we have financially, we have a lot of restrictions on the business operations. A lot of businesses just can't earn their revenues like they used to be able to. And you have a broader impact, of course, across the total economy. And so the problem here with the pandemic period, from an investment perspective, from any perspective, frankly, is that no one knows how long it's going to last and how hard these lockdowns are going to be. We're lifting restrictions in a lot of places in the world. We're seeing spikes in cases. Are we going to put those restrictions back? How long is it going to take? The world's leading medical scientists have no idea if we'll even be able to develop a vaccine for this, let alone when it will be developed. There are a lot of people in the stock market who think they know the answer. Some of them it's going to be in the next couple of months, but I think I know whose opinion I'd back, frankly. I mean, we've got to be a bit realistic here. And so it's challenging, from investment, because it's how long and how low does it go is not known. And then when we come, frankly, to the subsequent economic period, we are pretty cautious around the economy here. You've had an amazing level of government stimulus, fiscal and monetary, to really deal with the damage to the economy. And look, that's a positive thing. It's undeniably a positive thing, and it could have gone a lot worse. Governments have really broken new ground in terms of their speed and extent of stimulus, which is ultimately good for the economy. It may have some long-term consequences, but it's ultimately good for the economy. And so how we weigh all that up is really hard to see. But we've got very high unemployment. Is unemployment going to go back to where it was 3 or 4 months ago in the major developing economies, by the end of this year? I just think that's very, very challenging. So when we think about a winner, and maybe I think we've got a slide we could just pop up here, and I'd say, look, so what is a winner in this environment? Well, I'd say the first type of winner that I describe is a business that's resilient, frankly, in this environment. And that's a business that's resilient to both these periods. A business that's resilient in the pandemic period, basically a business that gets to operate in a relatively unaffected way during the pandemic. And then it's a business actually that we've got a risk of a big recession coming out of the pandemic. And it's a business that's resilient in a recession. And in this slide here, you can see that's that top row. We're calling resilient businesses. And for us, that's some US regulated utilities, and Gerald is the expert. I'm not going to try and talk to them too much. And then we've got some consumer staples. We've got Novartis, a pharmaceutical company, and Crown Castle, a communications infrastructure business. And look, think about these consumer staples. We've got Nestle, a food company. We've got Pepsi. It's actually a snacks business. It makes 70% of its money from selling chips, crisps, not actually soft drinks. It's a bit of a misnamed company. And then Reckitt Benckiser, they own Dettol, they own Nurofen, and many other sort of leading, health and hygiene brands. And so you can imagine that, Reckitt is frankly having a fantastic time right now. They're one of those businesses that's truly benefiting from this pandemic because people are doing a little bit more cleaning these days. And look, and so we think about them and we say, well, look, it doesn't really matter what's happening in this pandemic. People are still buying their chips. They're still buying their Dettol. They're still paying their electricity bills. They're still using electricity for these utilities and the gas. And so they're pretty resilient. And actually, when we come out, these are kind of, consumer staples, essential services. You still need them in a recession. You cut back all your discretionary stuff, and you still keep spending on this stuff. It's the bottom drawer stuff in people's personal budgets, to put it. And so these businesses are resilient. And what that means from an investment perspective for us is that we can get a decent return here. We've obviously we can't overpay for these things. You're not going to get a return if you overpay for anything, but we can assess the value with pretty high levels of conviction. We actually don't need to take that much risk in order to get a return. And that's very attractive. Investing is about risk and reward, not just about reward. So I'd say that's the first type of winner. And frankly, we're talking here in the context of COVID, but these are businesses, you can see here on the slide, the end of last year, before we were worrying about COVID, we had 21% of the portfolio in these businesses, and by the end of March, we've actually increased that. I added Pepsi in that period, really in response, to what's going on. But, these are businesses that we would like to hold when we think about capital preservation at all times as a core part of our portfolio. It's not just about COVID. And look, then I'd say, let's talk a bit beyond just the COVID consideration and think about, what is a winning business? What is a winning investment? And I think one of the key things you want to think about is long-term structural winners. Businesses really with the wind in their sails for very long periods of time. And so here, let's look at some of the big long-term tailwinds that we've got in our portfolio. We've got the Chinese consumer. This is the growth of the middle class, expected to double, and that works out at about a 7 or 8% annual growth rate for the next maybe decade. And then you've got a step up due to the wealth effect, the affluent consumer, the highest spenders in China. That consumer group could be growing about 20% per annum for a decade, right? That's phenomenal. That's a real tailwind. And so businesses that are hitching a ride on that, Tencent and Alibaba, the two big Chinese tech platforms, Starbucks with enormous store rollout plan in China. We'd say 50% of Starbucks' growth over the next decade is going to come from China. And obviously the luxury companies, LVMH and Estee Lauder, about 35% of their businesses are in China. So that's a big theme. That's their long-term winners. Then we've got payments, Visa and MasterCard, the shift from cash and check to electronic payment. Again, that's a very obvious tailwind, I think. And the shift to online advertising, Alphabet, which owns Google and YouTube, and then Facebook, they are just winning so much share of total advertising from traditional print and television. And so these are long-term tailwinds, and these are long-term winners. And look, some of those areas are cyclical. You think about advertising, you think about payments, even some of the luxury companies, particularly very discretionary. So these have long-term tailwinds, but in response, frankly, to the situation we see, not so much around COVID specifically, not around the virus, but around the economic impact that it's having, we've trimmed some of these positions, as you can see on this slide. We've particularly the big tech cyclicals, we've taken that down in our portfolio. That's where we've gone. We've gone more defensive and increased cash. That's some of the source of the cash has been those positions. Just to give you an overall context. And I think I'd say, we think of winners and losers. I mean, we are, as we've, I think as Gerald and I are really trying to emphasise, a big part of Millennial's DNA is avoid the losers. When we talk about high quality, that's what we're talking about in essence. So we don't have losers in our portfolio, I would argue. And I think we never do. Certainly if we're getting it right, certainly if we're doing our jobs well. But look, outside our portfolio, there are a lot of businesses in the broader investment universe that are facing a very challenging time. You think about traditional retailers, you've got what's going on here is really, it could be the final nail in the coffin for many of those businesses. It's really accelerating that decline. And I think even beyond just retailers who own the shops, if you're a brand that isn't engaged with online, you're not participating in the online channel, you're really at a risk of being left behind here. And these are the types of shifts, you think about e-commerce just simplistically. If you're a person who's never used e-commerce, the last couple of months, you've probably given it a try. And you're probably going to keep giving it a try. You're not going to give up on that. It's kind of like it's a new forming habit. So this is not just a one-off. Like something like a Nestle, they're getting a bit of a one-off because people have stacked their pantries full of those products. And that's not going to compound. But some of these other shifts, they're somewhat permanent. They're acceleration of a change. It's not just going to go away. And so when you've got those types of things happening, I think, there are a lot of businesses out there that are very challenged. And frankly, as well, if you think about parts of our investment universe, banks, say, for instance, savings and loan banks, you've got a weak economy, which threatens credit losses, frankly, and then you've got very, very low interest rates, which makes it very hard for banks to make a decent return on their capital. So there are big parts of the economy that are finding the situation very challenging, in our opinion.
And Gerald, on this theme of COVID and the winners and losers, there does appear to have been, quite a dispersion in the winners and losers, specifically in infrastructure. Would you mind spending a bit of time talking about that?
Yeah, absolutely, Paul. So we've got a slide that sort of shows our portfolio structure, and this is probably the easiest way to think about where the winners and losers are. You'll see we're showing you our portfolio structure at the end of December and then at the end of March. In both cases, you'll see the utilities are in the yellow and orange parts of the pie there. So we're roughly 41% in utilities at December, 43% at the end of March. Utilities, as Stefan's already said, are providing very reliable earnings and therefore very reliable returns. They're not necessarily a winner here, but they're certainly not a loser. They're a relative winner, if you like, just through the sheer consistency of earnings that we would expect. So then you move to infrastructure, and infrastructure really is transport infrastructure. It's the movement of people, goods and data across networks. So given the lockout of physical commerce that we've experienced through COVID-19, it's infrastructure companies, in particular airports and toll roads, where we've seen more problems. But if we deal with the different segments, communications are communications infrastructure, which is towers, the infrastructure required for mobile telephony and internet and so on. Clearly, that's been a winner through this period, and indeed, these companies have done very, very well. Indeed, beyond just this period, the movement as from 4G to 5G is going to mean that these companies face further tailwinds to their underlying income stream. So there's a good story there for communications. We're sitting on this webinar today. I can tell you my days are increasingly spent around webinars and mobile telephony. And clearly these companies are a big winner out of that. Energy infrastructure is oil and gas pipelines that toll the volume of oil and gas rather than the value, as we talked about before. These companies in the short term are largely unaffected by the crisis. The crisis has led to a reduction in the oil price. That could mean that the future growth opportunities for these companies are somewhat crimped. But their underlying income streams as they sit there today and as they would project over the next 3 to 5 years, look pretty solid in general. It's not like we're about to stop using cars, and them typically moving oil around for petrol or to be processed into petrol. They're moving gas around for communities. So those two sectors are largely unaffected. Airports, toll roads and rail are a little bit different. Airports clearly a big loser through this period. You can see we've moved out of airports through the quarter. Airports today are still largely locked out. There's certainly some passenger movements happening, but it's pretty limited. We expect to see that start to the airport travel, that is, to start to come back in July. We're seeing different jurisdictions start to open up. That'll happen first, we would expect, for domestic passengers, then secondly for regional, and thirdly for intercontinental. And that framework applies around most of the world. So there remains a significant uncertainty as it applies to airports and the way that aviation comes back, but we're confident that over the long term it will come back. There have been a variety of demand shocks in the past for airports: September 11, the GFC, SARS, the failure here in Australia of Ansett. So demand shocks is not a new thing in the aviation sector. Historically, what we've typically seen is something like a 15% hit to passengers in affected markets, and that those passengers have come back over a sort of a 6 to 18 months time frame. Here, given the total lockout of aviation, we expect a much longer protracted recovery, and we're probably not expecting to get back to 2019 passenger levels until something like 2024. So quite a long protracted recovery with a large degree of uncertainty. And the airports that we're happy to continue to invest in are those airports with generally low levels of debt, who are exposed more to domestic and leisure travel rather than business travel. We think business travel will be the last part of the aviation sector to come back. And therefore, these are companies that can handle long periods of the lockout, and their share prices have been overly discounted. So we're much more reduced position in airports to reflect those uncertainties, but we're confident that will come back. Toll roads is a different proposition altogether. If I look around the world, what we've typically seen in toll roads is that car traffic has fallen something like 70 to 80% at the height of the crisis, and trucks have fallen by something like 40%. Already we're seeing that in those markets that have opened back up and eased their restrictions, we've seen that come well back. So we're seeing quite a recovery, such that traffic is down in major jurisdictions where those communities have been opened up, something like 30% today compared to pre-COVID-19 levels. Still down significantly, but a significant recovery in quite a short period of time. And again, we would expect toll roads over a relatively short period of time to come back to something that we would expect to look like normal traffic levels. It's not going to happen automatically, but we would expect it relatively soon, let's say a 2 to 3 year period. And indeed, for urban traffic, and these are the roads that Transurban owns, for example, the roads in Melbourne, the roads in Sydney, the roads in Brisbane, for urban roads like that exist in a single urban city centre, we'd expect that traffic probably to come back even more quickly than that because of just the uncertainty surrounding public transport. So it's certainly a trend we're seeing already, that these urban traffic has come back to relatively even more quickly than what I'm talking about, and it gives us some confidence about the medium-term outlook. So it's utilities for our world, largely unaffected. Within infrastructure, communications and energy infrastructure, well, communications actually positively affected, energy infrastructure largely unaffected. Toll roads and airports have suffered some short-term declines. Airports are going to take a while to come back. Toll roads, we're relatively comfortable about over a medium-term outlook.
Stefan, you had that great slide before with the names of the companies that you're currently invested in the Magellan Global Trust. Would you mind just spending a couple of minutes perhaps on a couple of the key positions within the portfolio at the moment?
Sure, we'd love to talk about them. Look, I'd say, Paul, let me talk about the biggest position, Microsoft. We clearly like it. We've got 9% of the portfolio invested in it, and look, I'd say what's really happening here, we understand was really underpinning Microsoft. There is the enterprise software market, enterprise IT market, I should say, is a huge market. It's not consumer facing. We don't see it all the time, but it's just gigantic, and it's undergoing a very big shift. And that's what people refer to this as the shift to cloud computing. And what that means, if I just put it into simple terms, is that companies used to have a big server, like a big computer box that sat in the middle of their offices. We had one. Ours wasn't that big, but you imagine what the size of the one that CBA has got. And it sat in the middle of their offices. And as they moved to cloud computing, they're replacing that box with what we call hyperscale data centers. This is where you have thousands and thousands of these computer servers all in one big shared facility, and hundreds, thousands of companies are using the same facility and these server farms. There are three big players in this market, go globally outside China, and that is AWS with Amazon, a business called Azure, which Microsoft owns, and then the third, which is Google Cloud Platform, which is owned by Alphabet, right? They're the three big players in this market, providing these big data centers. And the thing with these big data centers is what they do, they lower the cost because there's much better utilization. Effectively, it's like a shared resource, so it's much better utilization. And hardware is very expensive if you want it to be leading edge. And they make it a lot more flexible. You don't need to access the server that sits in the middle of your office in order to use all of the IT. You just need an internet connection. And we've all got an internet connection in our pockets now 24/7. And so it's really opened up the world. So the big thing here, the first big thing for Microsoft is their Azure business. And this is already, a $20 billion annual business on a run rate basis. That's huge. And it's growing very fast. I would say, it's quite conceivable, 3 or 4 years, just Azure itself is going to be a third of Microsoft's revenue. Microsoft's the most valuable company in the world, so a third of that's a big thing. And look, so that's a big thing. Azure is growing very, very fast. Interestingly, the last quarter we just had, those three big cloud companies I mentioned, none of them missed a beat as a result of COVID. They might, this current quarter, when they next report, there might be a few little hiccups with new project implementations slowing down a little bit, but it's interesting. Actually, you'd think of something like enterprise spending is typically cyclical, and the economy's had a big hiccup, but these businesses didn't display any of that, which is interesting. They're quite resilient, actually. And so that's interesting, and that's good. It's a big part of Microsoft's growth. But an even more significant thing, or another equally significant thing, is that because what's essentially happening here is that the plumbing, the foundations of IT is being reconstructed. And that means that everything that sits on top of it, which is software, has a lot more possibility. It really is opening up. Microsoft's biggest software by far is Microsoft Office. That's Excel and Word, and they call that, enterprise productivity. It makes us more productive, Paul. And so we, that's about a $35 billion business, Microsoft Office. And so what's happening is that because of the cloud computing, the improvements that we've driven, people are spending more and finding more uses for software. And so it's driving a big uplift in terms of the use of software. And that's Microsoft's traditional core business. So all parts of Microsoft are being transformed and accelerated from this big shift to cloud computing. That's really what really underpins it. And because it's such a big shift, and because it's going to take such a long time to fully play out, it's going to be over multiple decades, what you've got in Microsoft is you've got a multi-decade growth runway. There'll be a pretty high conviction here that's going to play out. Once people put all their IT into one of these data centers, it's kind of stuck there. It's not the kind of thing that you just replace and move around. So they're very strong businesses. They've got, their customers are stuck with them, the traditional software model. So that's very attractive. That's really what underpins Microsoft. And then look, I'd say another area I'd call out, which is another big part of our portfolio, is actually the Chinese technology platforms. And this is Alibaba and Tencent. In combination, this is a bit over 10% of our portfolio. Well, about almost 11% of our portfolio, those two together. And look, I'll talk about them actually in parallel, because from an investment perspective, there's actually a lot of similarity. They both have super strong core businesses. For Alibaba, that's e-commerce. Their Taobao and Tmall combined is 2/3 of the Chinese e-commerce market. That's an incredible market position. They are the biggest e-commerce company in the world by far, and they've got an absolutely dominant position in the fastest growing e-commerce market in the world. That's a wonderful place to be. Their e-commerce business is growing 25% year on year. And for a business of that scale, growing at that rate. And then in Tencent, you've got about 50% of the Chinese online gaming market. They're by far and away the biggest online gaming company in the world. And it's a very dominant. And you've got WeChat, which is it's ubiquitous social media, communication, do everything on your phone type app, super app in China. Pretty much everyone in China uses WhatsApp. WeChat, sorry. It's the Chinese. It's like Chinese. It's like the Chinese equivalent of WhatsApp and Facebook and Instagram, kind of all put together almost. And that underpins a very attractive and strong advertising business. So somewhat similar, to Facebook. Some parallels to the Facebook advertising business, frankly. And so they're the core businesses, and they're very attractive. And then we think about these companies beyond the core businesses. What you've got is what it calls a number of nascent businesses, early stage but very interesting businesses, and again actually very similar between the two. They're the two leading players in cloud computing. I was just talking about Microsoft Azure. So the Microsoft Azures of China are Ali Cloud and Tencent's cloud business, number one and number two. And then you've got they're also with Alipay, which is part of Ant Financial, which Alibaba owns a 1/3 stake in, and their businesses are essentially very integrated, hand in glove. And then you've got Tencent Pay. They are the online payment duopoly in China. And the adoption and the usage of apps and e-commerce and online payment in China is well advanced compared to the rest of the world. So this is really the way forward, and these are the leading companies in that area. But these nascent businesses, the cloud, and both of these companies have a lot of other things as well. They're not all identical, but these are two of the big ones. But these nascent businesses, the payments and the cloud, they're currently loss-making. So when you look at these as stocks, what you've got these valuable pieces of the business that are part of the share price, they're part of the value, but they're actually negative in the earnings. So when you look at the company, you think, you're paying quite a high multiple for that company. But you've got to strip out that value and those negative current earnings. What you find is that what you're paying for the core businesses, that dominant e-commerce and that dominant social media and advertising and online gaming business, is actually a very attractive multiple. You're paying multiples in the kind of mid-20s to 30 times forward earnings for businesses that are growing 25% year on year and that have incredible market positions, dominant market shares. And from an investment perspective, that is actually very attractive. I would touch on, though, I think you need to always be balanced in investing. And look, when we look at China, these online platforms, and Gerald frankly was talking about this when talking about the infrastructure space within China. China is a different place and it's a different regulatory environment. And actually, how did we get comfortable, putting a sizable amount of our portfolio into that type of environment, and taking those types of agency risks? And look, I'd say to you, we did a lot of work to really understand what really went on, particularly the history around Alibaba and Ant Financial. And frankly, when we did a lot of work to really understand what went on, we became a lot more comfortable. Actually, we don't believe that foreign shareholders were overtly expropriated. I think there's a lot more complexity to it. But at the same time, as Gerald rightly said, when it comes to the toll roads and the rules and the goalposts have shifted on them, if the rules get shifted on you in China, you can't go to the Chinese court. Good luck going to the Chinese court system and getting a better outcome. We ultimately get a level of comfort in our investment because we believe that these two companies in particular, they're aligned with what the authorities want to achieve in China. You look at the COVID situation. Alibaba in particular, they've been behind this contract tracing app that's been very successfully implemented in China. They're doing a real service for society. Alibaba actually went and said to people who've lost their jobs in other sectors, "We'll give people jobs." They do a lot of things, and ultimately they're part of China's plans to really upscale and upskill their economy. These are some of the leading businesses in China. So they're very aligned. And so we believe that actually we are not making an investment where our interests are opposite to the Communist Party's interests. Like if you're investing in China and your interests are opposite to the Communist Party's, then that's an investment mistake. That's likely to become an investment mistake. So that's how we get comfortable with that. We're thinking about the risk reward, and there's some of the biggest positions and some of the very attractive positions, over the longer term in our portfolio.
Absolutely. Fascinating, Stefan. Gerald, a couple of the key positions in the Magellan Infrastructure Fund?
Okay, well, I guess I'd choose one from the utility bucket and one from our infrastructure bucket. There are two largest positions, and that is Atmos on the utility side, Atmos Energy, and Transurban on the infrastructure side. Let's deal with Atmos first. Utilities are regulated. They provide an essential service in a monopoly setting, so not surprisingly, they're regulated. And around the world, the regulation works such that the regulator determines the price that you're allowed to charge consumers for delivering, in this case, gas. Atmos is a gas utility. And they work backwards. They sort of say you're allowed to earn around about a 9% return in fact, in the case of Atmos, it's about 10%. So you're allowed to earn 10%. So if you've got $9 billion capital, you're allowed to earn around about 900 million in equity. And it doesn't really matter, good times or bad times, that's what you should be allowed to earn. So as a utility, what you need to make sure is you've got as much capital as possible. That's how you maximize your profit. You've got to invest significantly in your capital base. And Atmos has got a phenomenal opportunity to invest in its capital base. It's a gas distribution network, gas transmission and distribution network. So it owns, if you like, what we talk about as the spaghetti network that supplies gas into households around in different communities in Texas. The issue that they've got there is they've got a lot of old pipelines, and there've been two or three well-publicised situations where old pipelines have broken down and erupted and caused a lot of damage. And what that means is that regulators, as a result, are very keen to make sure that if you're a gas distribution utility that and you want to come and replace some old pipelines, they're very keen to approve that. So they're getting a good rate, 10% return, and they've got a long pathway of CapEx. They're actually replacing more miles today than they ever have before in terms of their old pipelines. And if they keep going at that record rate for 20 years, in 20 years' time, they'll still have enough old pipeline, 50-year plus old pipeline, to keep going for another 30 years. They've got a 50-year pathway of what we would regard as pretty attractive CapEx at a good rate of return. And there's a fundamental benefit to their community from doing that. In addition to which, you can't continue to just invest in your capital base forever, because then you have to put up prices. What they've got going for them is that gas prices are at an all-time low in the US. Again, coming out of the fracking revolution, there's a lot of gas available, so gas prices are very low. And as we look out to the futures curve is basically at zero. In other words, we're not likely to see gas prices rise anytime soon in the US. So a pretty good cocktail: long capex, customer prices shouldn't need to rise too much, and a reasonably attractive return to underlying consumers. It's not going to happen in any given year. In other words, the share price here is not going to double in any given year. But what we expect is a long duration of earnings growth, slightly better than what people expect. And it's that duration arbitrage is what we talk about that makes it an attractive proposition with what we would perceive as a relatively little downside. So that's Atmos Energy. Transurban, a company that most of your clients, I imagine, know and experience in some way, shape or form. Transurban ultimately sells you time. It owns toll roads around the world, urban toll roads. It essentially owns the urban toll road network in Sydney, Melbourne and Brisbane. That's about 90% of their earnings. And then it also owns some roads in and around Washington in the US. The essence of toll roads is that you're, as I said, you're trying to sell people time, you're trying to save people time. And while toll roads are not popular with consumers, they only exist in situations where the free roads are full and the government is broke. And if the free roads are full and population growth continues, then that population's only got one way to go. The traffic can only go in one place where the capacity lies, and that's on the toll road. So if I take Melbourne, Brisbane, Sydney, the ABS forecast for population growth is something around 1.25% for the next 50 years. So we would expect continued population growth in each of those major population centres. As the toll roads exist because the free roads are full, and therefore we would expect the bulk of that population growth to end up in traffic growth on the toll roads. And in addition, so you're going to get volume growth, or there's an underlying force for volume growth. And as a consequence of that, as we've looked back in the past, whenever you put up prices on toll roads, and so on each of those roads, you're looking at something like inflation linked toll prices, sometimes a little bit more than that. What we know about those price increases in the past is they've never led to a reduction in revenue. So this is a highly price inelastic service. You put up price, you can be very confident revenue is going to grow. So Transurban, the story is continued traffic growth in particular on the toll roads over extended periods of time, combined with toll increases and a relatively fixed cost structure. And it gives you some degree of confidence you're going to get continued growth in underlying cash flows and therefore in distributions to shareholders over a long period of time. And I might add, Transurban's one of Australia's few global champions. It is almost unarguably the biggest and best urban toll road operator in the world, and therefore it has a massive array of potential opportunity in the US. And that comes with a capital commitment. So They can only build new toll roads by spending some money, so it's not a free ride. But there are a raft of potential opportunities that they face. They've been very disciplined in the way they've gone about that to this point in time, but it's a little bit of cream that we could potentially be seeing in future years. So Atmos on the utility front, Transurban on the infrastructure front.
Thanks, Gerald. Stefan, a last question, and by far and away the most popular question that was submitted prior to today's webinar. The outlook for markets, what are you seeing?
Everyone's favourite question. Look, the stock market's going to go up 50%. No, we don't know exactly what's going to happen in the stock market, particularly over the short term, and we don't invest on the basis of trying to make that judgment. Frankly, I think that would be crazy. And look, I would say, Paul, look, ultimately, we look at the virus, and it is very significant, and the impact on the economy is very profound, and that matters for investing. And as I was saying, we are very cautious around that, and we've become cautious in our portfolio. You know, MGG started the year with around 3 or 4% cash, and now we're at 18-19%. You know, and we got to that level of cash by the end of March. And so look, we think the risk reward now is the situation is very difficult to judge, and that makes the risk reward less attractive. And I think I'd say in markets, look, the last couple of months we've had a really strong rally. We had a very fast ride down, and we've had a very fast ride back up. And I think there are a lot of people in markets who are probably panicking, thinking they've missed out. And people get that kind of, that emotional, oh, I better just forget it and do it. The stock market tells me it's okay, so it must be okay. And I would really say, just have a bit of patience, have a bit of caution. Patience almost always pays in investing. It's one of the great things is investing. It's your free choice every single day when you buy something. You don't have to, just because the market's flashing up the lights in front of you. And so that's what I would say is really, look, we're cautious, and I would encourage people to just be cautious and be rational. Don't get caught in the short-term market movements in any direction.
Some very wise words of wisdom, Stefan. And what about you, Gerald? Dare predict what the outlook for investment markets is?
Yeah, in the short term, I'm with Stefan. I'm not going anywhere near that. We would always say that we really don't know what's going to happen in the next 6 months. But what we can be confident of is over the long term is that demand for the sort of companies Stefan's talking about, and certainly the companies that I'm talking about, is not going away. The demand for energy, the demand for water, the demand for transport is not going away. And therefore that underwrites the long-term investment thesis for these companies. We may face some volatility and some uncertainty in the short term, but in the long run, the investment proposition that these companies offer us is pretty robust and pretty solid. And therefore we would tell investors to be patient, to remain sane, and to continue to expect reasonable outcomes over time.
Thanks, Gerald. Further words of wisdom. Look, we've run out of time. Stefan, Gerald, on behalf of our clients and guests, a big thank you for your time today, and a big thank you to the Magellan team behind the scenes that have made this webinar possible. We do genuinely appreciate it. Stefan, Gerald, stay well. Our clients, thank you for dialing in today. Stay well, and we look forward to catching up with everybody face to face. Thanks for your time.